So here we are in the thick of this COVID-19 recession. It's impacted everyone literally in the entire world. There's massive unemployment in this country, and many of America's small businesses are struggling. The streets in many areas are empty, and many businesses have closed, some for good. Commercial strips and downtown areas that really define many cities have turned into ghost towns. Businesses have sent their employees home, and they've shuttered their shops, and most of the schools are closed. Whole economies have shut down. Now, what's important to realize is that many of these jobs are not coming back after the economy reopens. There are huge numbers of rising delinquencies with renters and home and commercial mortgages as well. Now, it's August 26th today, and as it stands right now, there may not be another stimulus bill until mid-September, if at all. And we're smack dab in the middle of a recession that economists say is the worst the U.S. has experienced since the Great Depression of the 1930s. Now, the U.S. economy shattered records when it plunged 32.9% in the second quarter, according to data released by the Commerce Department in August. And it's only expected to rebound to the tune of 26.2% in the third quarter, according to prediction models at the Federal Reserve Bank in Atlanta. This country's GDP fell 5% in the first quarter, as the United States really effectively closed for business. It was the largest one-quarter drop since the final quarter of 2008, as that recession was in full swing. Now, there are 30 million people receiving unemployment benefits in this country and over 17 million people that are currently unemployed. Now, at some point, as I said, the government's going to have to stop sending stimulus checks, and we may have already reached that point. The government will have to also stop enhancing the federal unemployment benefits, that extra $600, and the national eviction moratoriums have effectively been stopped as of today. It's not likely that they'll be extended. It's also not likely that the payroll protection program that helped companies in maintaining their workforces will be extended. Now, this program was targeted to run until September, and already many companies, including but definitely not limited to airlines, are anticipating laying off workers once that program expires. Now, what's important to realize is that the U.S. consumer spending is 70% of our economy. Consumer spending. Now, consumer spending is the biggest driver of the U.S. economy, and it declined at an annual rate of 34.6% during the second quarter of 2020. It's by far the sharpest decline on record. And of course, a consumer's income and their future perception of that income has a dramatic effect on their desire to spend. Bankrate.com survey discovered that Americans plan to spend less or even much less in the foreseeable future. Now, let's talk for a minute about the different demographic groups that will be most impacted by all of this. Recent research shows that while the number of employed people who make more than $32 an hour only fell by as much as 2%, the number of existing jobs that pay less than $14 an hour fell by 20% below January levels. The next wage bracket, which is $14 to $20 an hour, has also have very high unemployment. So the lowest income families are the ones that are going to suffer the most in this upcoming crash. Also, unemployment has definitely risen for the younger, what's called the prime age workers, which is age 25 to 39. So they're becoming more and more jobless. Now, in the news, the New York Times recently posted that the United States is facing a wave of foreclosures and evictions as this stimulus runs out for millions of out-of-work Americans who don't have a financial cushion. Now, I interviewed the famous economist Harry Dent on my podcast, and that interview went live this week. And Harry's a Harvard-trained economist who's written several New York Times best-selling books. So how do I know Harry? Well, I saw him speak in Vancouver over 20 years ago, and had I listened to him and his predictions of what was coming in the future, I wouldn't have lost $50 million in 2008. He absolutely predicted that crash. Now, Harry studies demographical information about population growth and spending cycles, and he incorporates other cycles, including the 45-year technological cycle and the 35-year geopolitical cycle. And he's predicting a massive downturn literally right around the corner. Now, he's predicted it for years and told me that the virus was really just the perfect catalyst. It was going to happen sooner or later anyway because the governments have been pumping up the economies artificially since the crash in early 2009. Now, he told me, had the government stayed out of it back in 2009, yes, the crash would have been more devastating, but it would have cleared out a lot of the excess debt and excess pricing. But of course, the government didn't allow that to happen. Now, he also told me that we're now in what he calls a confluence of all of these cycles, and we have a very large artificial bubble in our pricing. Now, I'm sure everyone realizes that printing trillions of dollars couldn't possibly be a good idea, printing them out of thin air. People like Warren Buffett and most of the major bankers and major economists have all indicated it's a bad policy. Now, with this COVID, we have literally printed more money in the last several months than they printed in the entire 7 years after the 2008 crash. Now, back in 08 and 09, they put the money into the banking system to keep the banks from falling down. The money didn't go to consumers, but it caused the stock market to go up and real estate to rebound. But what's astonishing is back then we had 240 trillion in financial assets globally. This is before the 2008 crisis. We now, before this one, we have $477 trillion worth of assets. Now that includes real estate, stocks, bonds, gold, silver, you name it. 477 trillion in an economy that's actually weaker than it was and has less strong demographics than we did in 2007. And Harry says that the bubble is going to have to burst. Now, what's been happening is companies have been using cheap borrowed funds to buy back their own stocks and leverage their money to speculate inside of their own stocks. Now, this has artificially driven up their stock valuations. Governments have been buying their own bonds to push interest rates down, which allowed them to float more debt. Now, Harry's predicting a 50% drop in real estate values in this crash. Yes, you heard me correctly, 50% drop. Bigger drops are going to be in the higher end properties and probably less of a drop with everyday homes. But if you look at that $477 trillion number, here's an interesting perspective. In the 30s, which was the last big bubble, those financial assets went down altogether, including stocks, bonds, everything, about 50%. So think about if you lose 50% of 477 trillion in value. I mean, just to give it some perspective, 30 to 40 trillion is 3 times the global GDP. Here in the US, we've got about 125 trillion of financial assets versus a $21 trillion GDP. Now, Harry calls it bubble economics. You create this artificial thing to keep from going down in a downturn, but at some point, you got to take your licks. You got to take your medicine and restructure and rebalance, which ultimately makes everything healthier. Now, some economists are saying it's not going to happen. It's only a bubble. But what you'll see, what Harry says, what you'll see is when it does crash, they'll change their tune and they're going to say, oh, we're going to have this lost decade of 10 to 12 years. Now, Mr. Dent says we've already started what he calls the winter season, and that he's been predicting this winter season after the baby boomer peak of 07 based on those demographics, and it would last from 08 to 2023. That's the demographic decline because of the baby boomers, and it's a very steep one. But the good news is, and there's actually quite a bit of good news, so don't leave me here. I know it's been a little sobering, but the good news includes that it's not going to last that long, this crash that's coming, because the spending of the millennial generation will drive us back up. He thinks it's going to last until about 2023. Now, things will be even uglier in some of the countries around the world. For example, China. China is really going to have a problem. See, the Chinese have 78% of their net worth in real estate. To give you a comparison, in the United States, it's only about 30%. Now, China's going to get creamed. But let's talk about why I love this multifamily business. Now, as many of you know, it was my spread out single family portfolio that caused me to crash and burn in 2008. My multifamily did just fine, and it would have survived had I not cross-collateralized my multifamily with packages of houses. Now, the great thing about a recession and even a depression is that rents hold up. Cash flow tends to hold up. Yes, values will go down, but cash flow from multifamily will remain fairly stable. And which is what I experienced in 2008 and 2009. Yeah, we pulled back, but only about 11% in collected rents nationally, and that's about what happened to me. Now, according to Jonathan Kern, President and Chief Investment Officer of Civitas, multifamily weathered the storm more successfully than any of the other asset classes. Now, he said multifamily real estate suffered less and rebounded more strongly than the other major property types in the last 2 recessions. Not only did multifamily rents fall the least and recover the most, but they also fully recovered and then actually reached new highs within 3 to 4 years of each decline. Now, there will regretfully be a lot of pain in this country. There'll be a lot of people failing in real estate. Lots of businesses will go under. There'll be a lot of properties in foreclosure. But the good news is if you've got strong cash flow or you're sitting or have access to some cash, you're very likely going to be able to buy assets at 50 cents on the dollar or maybe even better. Now, the name of the game is to get in as much cash as possible or have access to cash so that you can capitalize on what's going to be a tough situation. Now, I've been using the phrase ethical opportunism or compassionate capitalism, taking advantage of the opportunities that are coming while, of course, maintaining your compassion and your integrity. So I asked Mr. Dent, how will we know when it's really started? And he says it's already started, but the lead indicator of this major downturn is going to be when we see the stock starting to crash, and he anticipates that happening very soon. He said that's your big sign. So let me circle back to something. How do you make money in real estate? Just like the game Monopoly, through rents, and real estate's worth what you can rent it for. It's all about cash flow, and there are going to be tons of opportunities. Average people are going to be caught up in fear, just like they are with this COVID business. But the people that can manage that fear and push through that fear, it's going to be very likely they're going to be able to take advantage of the biggest financial growth opportunity in our lifetimes. Now, another great thing about this rental business that we're in is we're seeing more and more baby boomers renting instead of owning. See, and Harry talked about this, unlike the Bob Hope generation, they went through the Great Depression and they went through World War II. The baby boomers grew up in pretty good times when they were younger. So they didn't learn to save like the Bob Hope generation did. And so many of them don't have enough money for retirement. And what they're realizing is that they've got paid off houses. So what many of them are doing is selling those houses and then deciding to rent. Now, for example, we've got a 100-unit asset here in Sarasota, Florida that's a 55 and over community, and we always have a waiting list. So, as I said, the proverbial stuff is about to hit the fan. It's going to be real ugly. But remember, with crisis comes opportunity. So what do? Do you run and hide in fear with this information? I hope not. Forewarned is forearmed. And like I said, with any crisis, there's opportunity, and the opportunities are going to be incredible if you are ready. Again, cash will be king, but it doesn't have to be your cash. If you learn this business, if you don't already know it, you'll have the confidence to influence investors with cash to help you each capitalize on what's coming. Now, if you haven't been to one of my boot camps, I'm having a 2-day boot camp that you can attend for $97. And I'm not selling anything there. It's a no-brainer. And I truly believe this is the best time in the world to learn this business because of this incredible transfer of wealth that's coming. Now, if you haven't subscribed to my channel here, please do, because I'll be continuing to put out updates and real estate related information regularly. If you're interested in my boot camp, go to multifamilyvirtualbootcamp.com. and I'll see you at the next boot camp. I'm Khleif, wishing you incredible passion and massive success in your business and in your life.